Welcome to today's webinar, the Canada State of the Market. We're excited to be back to provide another national update on what's in store for Canadian real estate, both commercial and residential, in 2023. I'm Jonas Locke. I'm Vice President, Business Advisory Services Canada at Altus Group. And today I'm joined by two of my esteemed colleagues. Peter Norman is our Vice President and Chief Economist, and Ray Wong is our Vice President of Data Operations. Peter will kick off the presentation today with a look at the impacts of several disruptive macroeconomic forces. Then Ray will share his outlook on commercial real estate with a look at the good news and the not so good news. Then we'll go back to Peter to wrap up the presentation portion with some observations on the housing market and what we can expect to see in terms of a reset. After these presentations, I'll rejoin you for the last 10 minutes to facilitate a brief Q&A. Which leads me to a couple of housekeeping items before we turn things over to Peter. If you have any questions today you'd like us to address during our Q&A, please submit these to the Q&A inbox. We'll see how many we can get to, and if we don't get to yours, we'll make sure somebody reaches out to you post-webinar. Everybody who registered today will receive an email with a link to view the recording, so stay tuned for that. And now, without any further ado, please welcome Peter Norman for a macro market update.
Well, thanks very much, Jonas, and thank you, everybody, for joining us. I think we've got a great crowd here today, and for this year's presentation. Ray and I are back after doing last year's, and we're always pretty happy about this one because it's very early in the year. We've got all of the year-end data, all of our internal data and stuff we've been collecting from other sources, and this is a great time to kind of assess where we've been and where we're going. So with no further ado, I'm going to talk just a little bit about these disruptive macro factors that may be influencing the market, and share a few of my thoughts on these, and then we'll move through the remainder of the material. Now, first of all, we're going to ask for we're going to ask you to participate a little bit, and I think a poll is going to come up. And as I'm beginning my material, you'll have an opportunity perhaps to interact with that poll. So starting off on these disruptive factors, obviously I'm going to start with inflation. Inflation has been perhaps the most important disruptive factor that is affecting current markets. Of course, the inflationary environment has a number of reasons or antecedents behind it, including the way we came through the pandemic, including interruptions to supply chains that are both pandemic related and related to the war in Europe and other factors related to monetary policy, etc. But I wanted to give a tiny bit of perspective just as we move into the remainder of the comments that Ray and I are going to be sharing over this event. I see inflation as definitely in very distinct phases, and that we're most of the way through the inflationary cycle. And I've illustrated on the slide here how you can sort of think about those phases. I mean, the first phase being sort of, the normal environment, where inflation was in that kind of 1 to 3% range prior to the pandemic for kind of reference and guidance. Then we had a kind of a steep deflationary cycle during the pandemic. That's when the economy was being shut down and variously in various components of it. And the recovery from the pandemic saw, as some of those components of the economy came online, so too did inflation, more of a makeup for that deflationary period. I'm calling that the 2-year normal, because through most of that period, if you averaged inflation over 2 years, it was still sitting at a pretty normal rate, both on the price side and the wage side. And then really it was in 2022 that we saw the effects of some of these, special factors affecting inflation quite quickly. And then it was in about June of last year that we saw inflation spike. Since that time, we've really been unwinding inflation. It might be unwinding a little bit slower than some of us would like. It might be unwinding a little bit slower than central banks have anticipated and would like to see. But nonetheless, it is unwinding, and it is unwinding quickly. And I think that this is a pretty good step-off spot in order to kind of look at one of the big implications of inflation, which is policy responses and interest rate policy responses in particular, as we go through the piece. So interest rates, of course, we would call this an interest rate spike, a classic interest rate spike. The Bank of Canada has made 8 adjustments. In fact, there are 8 in a row, and then there was, and then the most recent one was a hold announcement. But there were 8 in a row over a 1-year period of time. We had adjustments that added up to 4.25 percentage points. The graph is zeroed right in on that period, so it makes it look very, very steep, of course, and it is steep from an interest rate perspective. And bank rates that are policy rates, the Bank of Canada policy rate or the Fed rate in the U.S. Has an effect almost immediately on the real estate industry and on housing. And in particular, that sort of comes through with the rates that people that actually kind of affect borrowing and balance sheets. And I'm going to focus here on the mortgage rate. We did see the mortgage rate track up pretty substantially, almost 1-for-1 with the changes with the bank rate. And you can see how that has spiked up as well. When mortgage rates go up, we have a couple of different potential effects on housing and on households. And all of those give us pause for caution about the forecast for housing and the forecast for real estate in general. The first being that it can be disruptive in the sense that it will slow down transactions. So we've certainly seen that, and we'll look at that in a moment. But in addition to that, we have this kind of like lagging effect as well, that people who got mortgages 5 years ago, and those are those people who are kind of colored in blue, those are the last couple of quarters, and yellow is the kind of, the people over the next couple of quarters who will be renewing at much, much higher rates. They face a risk of default, although that has not been a very strong risk in Canada, in part because of the stress test and other factors. But certainly there's a big budgetary impact on those families, and they cut back on spending on a wide array of other types of goods and services, and as a result of and that has a kind of a slowing macroeconomic impact. So we're watching all of that, and those are components that we want to do. Last thing I'll just say on interest rates, here you can see a very long-term perspective over the last 30 years. And, this rise of 4.25 basis points up to 4.5, I mean, it's from a very low base. So 4.5 still doesn't seem that high by historical standards, but the rise is historically pretty strong, but it's not unprecedented. We have had, arguably about 4 other interest rate spikes. But the kind of good news is that they don't always result in unequivocal decline in housing starts. In 1995, certainly it did. 2009, now arguably there were the global financial crisis and other things led to a big slowdown in housing for us, but nonetheless, the interest rate spikes might have been part of it. But anyway, interest rate spikes don't always slow down construction, so keep that in mind when we get into that component of the piece. Overall, we asked you an opportunity to talk about the inflation, and sadly, I did not see those results. So I'm not sure what you said, but I will look at them afterwards with some interest. But nonetheless, we may or may not be going through a recession in the next couple of quarters. I put together an illustration here that shows, yes, we'll probably have a very mild recession through the middle half of this year, and then it will start to pick up. But overall, we'll have, a positive but slow growth this year and a little bit stronger next year. But the bigger component to talk about or to bear in mind is that even if we don't do that, even if we just kind of snick by without a recession and we go forward, and there's a good reason why that may be the case as well, it's going to feel a bit like a recession by the time we get to the end of the year and beyond, because we're basically operating now at a rate of about 1.5% annualized growth. That's that kind of like line that's going across there. And we've just spent the last 2 years operating at 3% annual growth on average, if you kind of average out all the kinds of ups and downs. And so in general, we're in a bit of a slower growth period, in part because some parts are at capacity, and in part because of this macroeconomic or this aggregate demand issue that we're having. And, I'm not going to speak to the different provinces as we go across, but, in general, we're seeing almost all provinces looking at slower economic growth in 2023 than what we've seen in the last couple of years. You can sort of see the way that the pandemic played out with the pandemic recession, and the recovery played out a little bit differently by province. It's a little bit deeper in Alberta, for example, a little bit less deep in BC. But in general, we see that most provinces will have positive growth this year, but very slow growth. Alberta probably the strongest growth, and perhaps Ontario being kind of the weakest growth as we go through 2023. Job growth, on the other hand, has been persistently strong. That's kind of a positive factor, and I think that that's an important thing to kind of bear in mind. And it doesn't really seem to be slowing down. I mean, in addition to job growth, we have a thing that we're looking at, which is called job vacancies. It continues to be very, very high as well. Companies are still looking for workers and finding them hard to find. Now, they might get some relief because we're starting to pick up on in terms of immigration. And immigration is driving population growth, and population growth is positive for the economic forecast, obviously, because it does drive, economic activity through spending and et cetera. And it also provides some relief for those labor force shortages. So there's an opportunity for the labor force to grow, and it's an opportunity for firms to expand their business as well. So the population, and of course, there's a real estate impact as well. And I'll just move on a little bit to my final point here. So there's a little few positives and negatives going through. Perhaps the final kind of more hidden disruptive factor that we are also keeping our eye on is household balance sheets. That's what we're starting to see deteriorating pretty sharply in this last 12 to 18 months since the interest rates started to go up. Both the debt level has gone up, but more importantly, debt service ratios have reverted pretty significantly during the last 12 months or so. Savings rate is still positive, but those high savings rates during the pandemic are starting to get really wound down as well. So we're also watching that. That's also something that affects consumers. As it affects consumers, it also will affect commercial real estate and housing. And so I'm going to pass it over to Ray to go through a few of those commercial real estate effects right now. And then I'll be back to talk about some housing after that.
Okay, thanks, Peter. So we're going to go through commercial real estate, good news and so good news, especially the last number of weeks. So Peter, let's just get into the next slide. Okay, so the quick poll that of course, is going to be about the housing market. So the question is, many companies with offices have stated their intentions to move forward with hybrid working environment. Which of the following most closely reflects your opinion? And in 5 years, do you think we'll all be back in full time, 3 to 4 days, 1 to 2 days, or by that time, we're not going to need office at all? Okay, so please respond to that. So we'll get into the first slide with respect to Nordstrom's. That's 1 million plus square feet of retail across Canada, right? So, and unfortunately, we've been through this a number of times with Simpsons, Eaton, Sears, and Walmart. And each and every time we've been very resilient in regards to the owners of these regional malls to pivot and change, subdivide, find other sort of retailers, and it's no different this time around. And to a certain extent, with respect to retail, it is coming back. But I think the pandemic didn't help either. And the question is, especially with Nordstrom, was this the right concept? And it's interesting when you compare Nordstrom with the dollar store, and if you look at a study or a report by Harding Levner, that Dollarama actually earns a higher profit margin than any large department store in North America. And that includes Target and Costco. So especially with the higher inflation, the interest rates, whether or not that sort of accelerate this process as well. And we turn to some positive news. The recent announcement by Volkswagen, the EV battery manufacturing plant to be set up in St. Thomas, Ontario. That's what 2,500 direct jobs. and about 7,500 anticipated indirect jobs. So the part of the reasons the Volkswagen chose Canada, and again, this was Volkswagen also facing number of incentives and from our neighbors south of the border, but the focus was basically on clean source of energy, skilled workforce, especially Southwestern Ontario, and being sort of the manufacturing hub for Canada, as well as certain cost benefits. So that's positive, especially with respect to all the news that we've been hearing on reshoring in the US. It's nice to see manufacturing has come back to a certain extent to the Canadian marketplace. And this is the hottest topic, the back to the office dilemma. So we go into, just click the first one for the reason to actually go in. If you've heard of this before, a sense of belonging, social identity, health and well-being, interaction and performance, career development, relationship, and for the most, and for me, is the coffee. It's amazing how much companies have spent on new coffee machines to lure people back in. But on the other side, with not to come into the office, especially in the larger markets such as Toronto, Montreal. I live north in the city, and my average commute before the pandemic was about 3 hours, right? So I think the larger markets are having a little bit more challenges bringing people back into the office, whereas the smaller markets such as your Ottawa, Calgary, Quebec City, Halifax, it's a little bit more of an easier transition. People don't want to go back to those 3 to 4 hour commutes, and goes back with safety, well-being, work-life balance. Again, a lot of the things that we've seen over the last little while sort of accelerated this with the pandemic, and have given people sort of a transition. And what we've also found was some jobs just don't require, our departments don't have to be in the office based on the responsibility. But another reason to stay out is the cost. One, the commuting, the gas, and as well as the public transit. But if you've been into any of the food courts lately, pre-pandemic prices for food have gone up by 2 or 3 times. Okay, well, we turn to the overall leasing market. It's getting better, right? So especially when you look at the growth of 2021 to 2022 for Toronto and Vancouver, 5.5 to 5.9 million Toronto, 2.7 to 2.8 million in Vancouver. And just aside, with the pre-pandemic, in Toronto, we were at 7.8 million square feet, and Vancouver at 4.3%. So it's lease activity is getting a little bit better. But it's still focused on quality of space. So you look at the Class A activity, and Peter, next. It's most of the activity in leasing is actually in the Class A space, right? Followed by the B and C. And when you look at Toronto downtown, Class A still makes up 60% of the available space. Partially that's due to new supply. And the percentage of Class A of the overall inventory is actually up to 55%. So it still makes up a fair part of the inventory. But again, what we've seen in the marketplace, turn to the next slide, Peter, is the availability is still going up. For the most part across Canada, with the exception of Alberta. And if you look at some of that improvement, especially in Calgary, 26.4 to 25%, and partially Peter's going to get into regards to the housing activity, but they've seen quite a bit of interprovincial migration of people to Alberta, and mostly based on the affordability of housing. But they're having that huge sort of talent pool, especially with young people, and sort of the hybrid as well, allowing them to work at home. But I was reminded by a number of people that they're still at around 30% when you include the shadow vacancy or availability in the marketplace. But if you look at Vancouver and Toronto, basically the increase is also not just due to the people sort of downsizing or doing blend and extend on the leases, but it's also based on the new supply. And we're also seeing with new supply with office, of course, this shouldn't be a surprise that there hasn't been any other sort of office announcements or new constructions, with the exception of a few niche areas, perhaps mass timber buildings that fill a certain niche in the marketplace, and as well as more than likely on a smaller size. When you look at the sublet continues to tick up despite a bit of a drop over the last while. And this shows you to a certain extent of companies are still trying to figure out what is the right size. And some of it is coming up with 1 or 2 years term left. So the sublet is increasing, but the opportunities on the sublets is a little bit limited based on the term that's left. So we're seeing a lot of blend and extends in the market, and that's contributing to the increase into the availability rate. So let's turn to industrial, Peter. This is probably a little bit too dramatic, and this is Peter, by the way, near his home with a strong windy day. Industrial headwinds are there, but maybe not as not to this extent. And the biggest thing is the rental rates and how much higher can they go up, and how much can companies really pass on these costs to consumers and clients. And from a cost standpoint on materials, especially labor, they continue to move upwards, and especially with places like Vancouver and Toronto, with limitation of availability of land. And e-commerce, despite the slowdown in the economy, is expected to remain strong. So at least for that perspective. And the industrial availability, this is not a big surprise in regards to how low the availability rate is across Canada. We're just not building enough, or it's not enough, supply is not keeping up with demand. And we look at the construction side, if you look at the slide, that there's high availability rate in the buildings under construction. Next slide, Peter. Yeah, so despite the 64% availability of space available in buildings under construction, it's most of that, or all that space, is probably it's leased or sold before completion of the project. So despite the high availability of buildings under construction, a lot of this is leased or dealt with before they're done, and that really impacts the rental rates, right? And this is that 20 to 30% increase that we've seen the last few years. And again, it goes back to the question: how much higher can it go? And we know for the newer modern buildings, you're looking at north of, and this is a gross rent, between $20 and $26 a square foot. And Montreal has a slightly lower occupancy cost, but that's more due to the age of the buildings, and they have a little bit more older stock compared to some of the other markets across Canada. And again, that Calgary increase in rents is also indicative of the Vancouver shortage of space, and everyone knows a lot of the logistics or the warehouse and demand or goods are sent to Calgary and sent back over to the mountain to Vancouver. Next slide. The transactions are getting more complicated. Everything that Peter mentioned regards interest rates, inflation, and some aspects of market fundamentals, especially on the retail and office front. It talks to the not just on the sale price, but anticipation of the capital costs that have to go involved in getting certain buildings up to speed, especially on the office front, and especially with that goal with ESG, with respect to that the cost to get the buildings closer to net zero, and as well as with some aspect with owners to protect certain pricing to get the deal over the finish line. They're also looking at vendor takebacks to protect those pricing. And we've also seen a big shift toward private lenders, especially with increased scrutiny and criteria by the traditional lenders in the marketplace. And it doesn't really help with what we've seen over the last week with Silicon Valley Bank, and that whether or not it continues to push on contagion fears in the marketplace. And when you look at the overall sort of activity, and this isn't a surprise, and that land continues to be in demand across the board, and that's a positive thing. That anticipation of further growth. Office got a big hit over the last couple of years, especially with the shift in ownership away from the institutions more to the private players. And apartments, the demand is not down when you look at the activity. It's a lack of supply in the marketplace. So we see these trends probably going forward, but it'd be interesting with the availability of products, especially on the office side, and whether or not we sort of seen the end of that shift in ownership. But the positive side, that people still see, or owners, investors still see opportunity in that marketplace to stem with that type of growth. And it's all about the numbers, and probably a lot more scrutinization is being done with whether or not the numbers work. And, especially with what we just mentioned with increased pressure on capital improvement costs or maintenance and net zero, and as well as what are the yield expectations, especially from the office and retail side, and do some of the sale transactions now really justify the anticipated returns of the exit strategy in the medium or long term. So a lot more sort of scrutinization, especially on the lender side, with anticipation of growth in the marketplace. And do the 3 to 4% cap rate, especially on the industrial side, based on the lending at 5 to 6%, does it still make sense? And when you look at the overall cap rates, and this is our investment trend survey, so it's over 120 of our clients that participate in the survey, and they were sort of sensing cap rate movements going up higher before they actually went up. So there's a natural delay when you look at this chart, and when you look at the transaction volume and the deals coming across. But we're still anticipating, we're waiting for the first quarter's numbers, but I think we're going to see a continued trend. This is not to say that core assets will still fetch multiple bidders and as well as a low rate. But again, it's probably less so compared to especially about 12 or 18 months ago. Okay, to sum up, what we anticipate in commercial, it's going to be a bumpy road ahead of us. I think there's going to be a lot more noise going over to the next, at least first half of this year, and probably now into the back half to a certain extent. Market fundamentals, for the most part, will remain stable, especially with the amount of sublet still in the office side. But again, it's that those future numbers and anticipation that impact with interest rates and inflation will still play in the marketplace, perhaps in the way of hesitation of some of the transactions. And we're also still dealing with price discovery from a vendor and purchase side. So what we do like is still industrial, multifamily, and as well as hotels. I'm not sure if people start traveling, but the amount of occupancy costs in some of these hotels, it is going up. And what we see more of a transformation is on the retail and office side going forward. But again, I expect this year to be a bit of a bumpy road, and we're probably going to see a few more surprises. But the overall, I think CRE remains a very stable and a very attractive asset, especially for for investors. So again, this is going to be a little bit bumpy, but I think we're going to be okay. Turn it over to you now, Peter.
Okay, that's great. And so I'm going to spend a few minutes now talking about housing. But just before I do that, I just want to remind everybody out there that we are taking questions and we're going to leave a few minutes at the end in order to work through some of your questions. And you can submit those questions anytime. In fact, it might be good to get them into the queue now if there's something that you would like to ask. So I think that you'll see the little Q&A app or Q&A function up in the corner of your screen, and feel free to submit those questions. There is an option to either put your name in with them if you would like that, or to submit them anonymously. So we look forward to seeing some of those questions as well. And as we get up towards the top of the hour, we'll address a few of those. So I'm going to kind of wrap us up now for the next few minutes talking about some housing market, the implications of all of what you've heard so far, both the macro and the commercial real estate interface on housing, and share a few of my thoughts about where we're moving into 2023 and 2024 on housing. Now, first of all, just as with the other sections, we have a quick poll which is going to go out. So I will allow you to kind of answer that on your own, and if the results get texted over to me, again, I will this time I will try to read through them in a couple of minutes. So the theme of the housing impact maybe can be summed up by this one chart. This is, of course, the resale markets. Resale markets are a pretty good indicator of kind of consumer sentiment towards housing, I guess. It doesn't have necessarily a direct impact on the building and construction or commercial real estate sector per se, but it does certainly set the benchmark. Most of the home sales in Canada are resales. Last year was just under 500,000 sales, which of course was down quite a bit from the year before, but of course the year before was the outlier. Really, 500,000 was a pretty good year. I've tried to illustrate on the right-hand side kind of on the trend, kind of on a month-by-month basis over the last few years, how sales have gone. Certainly any sense of seasonality seems to have disappeared. But in particular, as we went through 2022, we did see that, moderation in housing, but it wasn't a downward spiral, and it certainly wasn't a kind of a big reset on housing. It was really a moderation. We really saw sales going down to around that 35,000 a month range, and stay pretty consistently at that range. So it's a more modest pace of transactions, but not a market that appears to be scared in general, or appears to be influenced by panic sellers or panic buyers or anything else. So we're reasonably confident that we're not in for a big reset on housing. In fact, we've seen a bit of moderation, and that's where we're at right now. On the construction starts side, you can sort of see a little bit of the trend, and also where I'm expecting them to go. And starts are holding up is the main thing. I mean, even right into February, we saw a very good number on housing starts. Last year was a pretty strong year. Was right up alongside 2021 as an exceptionally strong year. I expect it to be a bit cooler this year. Again, that's the theme. But by no means is going to be one of those sharp declines in housing starts like I was illustrating earlier in the presentation when we've seen other interest rate spikes. This is no 1995 for housing construction. It's just a bit of a cooling that's taking place right now. And as we scan across the country on that same kind of framework, we will see kind of Ontario and BC perhaps accounting for a little bit more of that reset that's going on. Perhaps there's going to be very little in Alberta and the prairies and Atlantic as well, where population growth is certainly driving a lot of housing need right now. So anyway, a little bit of differences across the country, but mostly still along those same kinds of themes. Now, on the housing price side, I've chosen to show them the most confusing and frustrating chart ever in order to do this. So it's like a bunch of spaghetti. But the main point is that we are seeing a reset in housing prices. I mean, housing prices nationally right now are down about 16%. That's the February print that just came out yesterday. And you might have read about in the papers today, Toronto down about 17%. So those are certainly some adjustments to housing price on a year-over-year basis. All of this is in the context to the fairly frothy housing price growth that we saw in 2021, which is now kind of adjusting out. And actually, interestingly, I've thrown in a couple of those near far cottage markets that were so popular in 2021 for people, remote workers moving out of major cities, places like Chilliwack and places like Kawartha Lakes. I could put Bancroft and some others up there as well if we wanted to look at that sort of thing. And those are the markets that saw the most froth in 2021, and they've had a little bit more adjustment now, negative, but those are smaller markets that have kind of special factors going on with them right now. Again, not a downward spiral, really just a price adjustment that you would expect to see when you see interest rates going up by by several percentage points. And on the new construction side, I'm going to start with Toronto here and show our numbers. I mean, the Toronto numbers seem pretty dour, actually. We had construction sales. Sorry, this is construction sales. So this is a new home sales. Sorry, new home sales. We saw a decline pretty precipitously into 2022 from somewhere close to, nearing in on 50,000 units down to 25,000 units. You can see over the right-hand side that most of that decline took place in the second half. So that, of course, is illustrative in part of the period when interest rates were a bit higher, and we saw we saw a little bit of pullback from consumers. But there's other factors that are going on behind this. First of all, a lot of that decline is in the single family sector, where supply shortages tend to still be really acute and affecting this market, and some other factors as well. Here's the supply piece that I'm talking about. For example, you can see that those single family supply numbers, inventory numbers, even though they may seem a little bit better than the terrible point they were in 2021, when we saw the really sharp spikes in price and decline in availability. They're still at less than 2,000 units for a market that size, in comparison to where it's been. Even in other supply constrained periods of time, like 2019, really is quite dramatic, and that's really what's driving that lack of sales, more so than anything on the demand side, I would say. Perhaps a little bit more balanced, or at least not unprecedented in terms of the shortness of supply of the high-rise sector, but inventory like this only tells part of the story, because a part of the story also in that second half was a kind of a delay on several launches, and when you delay launches, you're also going to delay sales as well, and that's kind of had an impact. So overall, things are not as bad on the new home sales side as perhaps that first chart would show. Another factor, of course, which continues to be challenging and has been challenging for a year or so now on bringing new product to market, is of course that construction cost side. And construction costs now may be moderating from those really terrible numbers about a year ago or so, where we saw construction costs rising quite rapidly on a quarter-over-quarter basis. But they're still rising, and they're still rising at higher than average amounts. It's just starting to moderate a little bit. And this continues to be a challenge, and will continue to be a challenge going forward, those construction cost numbers. So overall, very little reset in prices. We looked at the resale prices earlier as a kind of a leading indicator of what's happening, because they respond a little bit more quickly. But if we look at the prices, say in Toronto, which is on the left-hand side, for new product, just looking at the January numbers, January was down a little bit in both cases from a year before. But of course, both those prices, both on the single family and the condominium apartment side, still continue to be quite elevated from where they were even just 2 years ago. So we haven't seen, I don't think, a massive reset. I think this shows that, even though we have a little bit of softness in demand, most of it continues to be a supply constraint issue on sales, and the pricing on the new hasn't adjusted as much as we've seen, say, on the resale market. And there's some new house price data on the right-hand side that kind of takes us across the country and tells a little bit of a similar story. Prices are positive still, but a lot more modestly rising than they were, say a year before, almost across the country. And in terms of the volume, just switching back to volume of sales, but doing a bit of a scan across the country, on the single family side, kind of a similar story to Toronto, in the sense that we've had in some markets fairly good growth in 2021, in some cases 2020, in some cases 2021. but a little bit of a pullback in 2022 in many markets. And many markets are showing some of those supply constraints, and some of that is demand-based as well. But it's not the same picture on the high-rise side. I mean, we see markets like Calgary, of course, where the high-rise is starting to show a lot more promise. Even Edmonton has been up for the last couple of years. Some of those ex-urban markets around Toronto, like Kitchener-Waterloo, very strong year last year for condominium apartment sales. So a little bit of a mixed bag on the condominium apartment sales record as we went across the country. Now, I'm just going to wrap up for the next minute or a couple of minutes on talking a little bit about rental markets and rental and the multifamily asset class in order to give a few insights into that piece. And a couple of stylized facts from this kind of long trail of data that you're looking at here. So in 2022, we saw over like almost 130,000 housing starts that were apartments. So apartments started. And for the last couple of years, more than half of those were purpose-built rental starts as opposed to condominium. And that's in stark contrast to even going back 5 or 10 years ago, when the purpose-built sector was more like about 20 or 30% of a much smaller apartment supply pipeline. So we've definitely seen a shift into apartments in terms of new supply, but we've definitely seen within that shift, this kind of shift from condominium buildings into purpose-built, and that continues just even through into the latest data. Now, just bear in mind here that we're talking about 68,000, almost 70,000 purpose-built rental housing starts last year, and for good reason that we're seeing that new supply coming on. It continues to be a market that provides some promise. It continues to be a market that provides a return on the, and I think Ray spoke to this a little bit, and it's also one that shows that there is further demand for growth. But one of those indicators is, of course, a fairly tight vacancy rate. So the vacancy rates on rental have basically been tumbling since 2016. We did see them, jump up in the depths of the pandemic, but have corrected almost right away. And that trend is pretty much the same mostly across the country. A little bit higher vacancy rates in Edmonton, but in most cases, we're seeing vacancy rates that are well below, kind of a balanced market. And in many cases where there are tighter vacancy rates in many cases where we're seeing low vacancy rates, both in the rental condo sector and also in the purpose-built sector. In many cases, even tighter in the rental condo sector. A little bit about rental demand. I'm going to kind of reveal a few things here that we kind of look at because there is a concern, of course, that we've come through a cycle with strong rental demand. That cycle was the cycle when the millennials were in their prime renter years. They're now all in their prime home buying years. Certainly in the decade ahead, that will be the predominant influence that millennials will have. We have another generation, of course, just moving into rental now, the Generation Z, and that's driving a little bit of demand, but it's less demand than what we've seen. So there's good reason to say that rental demand may slow. And I think that's probably, yes, we'll probably see something more like about 85,000 net new rental households per year in the next, let's say 5 or 10 years. And it was almost 100,000 net new rental households per year in the last 5 years. And you can see that itself is a fairly volatile number. I mean, you only have to go back to the late 1990s, early 2000s, when there was absolutely no rental demand. There was no rental demand because that was a point in time when the demographics were not conducive to that. So as the demographics move, we do have to be kind of cognizant of where that demand will be. But I think that it's still good. It's not as strong as it's not going to be quite as strong as what we've had, but it's still going to be good. Does that mean that it's time to pull out of building purpose-built? I'm going to say no. And I'm going to say that kind of with my final point here. And there may be a couple of arcane points in here to make. But when we're looking at when we're trying to analyze what happened in that last 5-year period, remember I said that, or that's down in the lower left-hand corner there, that 98,000 or almost 100,000 rental households. How did they actually get accommodated, those households, over the last 5 years? Well, only 20,000, only 20% of net rental growth was accommodated in investment grade multifamily, newly built multifamily assets. So it's actually not the case that a lot of that growth was because we had a lot of investment coming on. The investment was picking up during that period, as we saw in that first slide I brought forward, but most of the growth was not accommodated there. A surprising amount of the growth was accommodated in single family homes. And that is actually the rental asset class right now, which is exploding the fastest. And it's below a lot of people's radars, and it's been happening. And a lot of it is a repurposing of what was previously owned homes. And in some cases, it might be, investors buying newly built homes. There might be a variety of experiences in that piece. But as you can see, almost like almost a third, or more than a third of the of rental household growth in the last 5 years has been accommodated in single family homes. And this is all growth related. Interestingly, you might see that production of purpose-built rental in the last 5 years was actually averaged out to be about 41,000 units per year, but it only accommodated 20,000 growth. So that's accounting for the fact that we've lost a lot of units in that stock as well, because there has been a lot of demolitions. So the purpose-built sector is renewing itself. It's getting more investment grade and renewing itself as we build new stock, many cases as replacement to older buildings. But nonetheless, it's still only accommodating a component of that demand. So, just looking at the previous chart again, we might see demand waning a bit from about 100,000 down to 85,000 in the next few years. But there's plenty of room, I think, for the purpose-built sector to gain some ground on the condominium rental apartment sector, and I think that there's still a lot of good deals there. So that's kind of takes me to the end of my remarks. I don't have a real summary for the residential piece because I gave my forecast along the way, but happy to answer questions when the time comes. So I'm going to turn it over to Jonas first before we go there.
Thanks a lot, Peter. I appreciate it. Some really interesting stuff today. So we heard a little bit about the economy to start off. I found it reassuring that some improvements are expected over the next 18 or 24 months, but also interesting to hear that there's still some challenges out there. In particular, deteriorating finances could still, have an impact moving forward. We heard about the commercial markets, and in particular, we heard that that there's some stability in some sectors and some concerns in others. We heard about return to work maybe being a challenge, while the industrial markets stay strong and the investment markets still seem to have a lot of demand. And then we heard a little bit about the housing market as well. And, it was interesting to hear that the reset has been somewhat modest, with minimal resets in pricing, despite, what we've gone through over the last year. So thanks to both of you for those presentations. As promised, we're going to turn it over to some questions that we got through our attendees today. We've got a lot of them. I just want to remind you that if we don't get to your question, we'll do our best to respond to you after the webinar is over. And quite frankly, we got a lot of questions, and I don't think we're going to be able to get to them all today. So I think I'd like to start with a couple for you, Peter. In a couple of questions came in around interest rates, not surprisingly. A couple came in asking, what's your comment on rates moving forward through 2023? There was even someone asking beyond that what you thought. And another person was asking if the recent turmoil in the US financial industry has changed that at all for you. So maybe you could comment a little bit on interest rates.
Yeah, I'm not sure if I've got a good cohesive answer to that second piece. That is something that we're working on presently, but it's real time right now. And so it might be a bit premature to weigh in on that at the moment. I will say that our expectation on rates in Canada is that we will not see any more rate rises this year. We will see, I think, the bank holding steady at that 4.5% rate. I think that fairly rapidly, within the next few months within the next couple of months of that staying stable, we will see that mortgage rate starting to float down. I think we've already seen some softness on bonds coming through. So it will start responding, going down. It'll be a leading indicator of rates starting to go down, but we won't see policy rates come down until maybe late in the year, maybe 2024, probably 2024, and then maybe slowly as well.
Right. Thanks, Peter. Ray, a couple questions came in for you around the concept of office space being converted to residential uses. There was a question in particular to Calgary's office, but there was also some for some other markets as well. Just curious to your take, Ray, on the idea of converting office space to residential, and maybe what kind of an impact that would have, if any, on on the markets moving forward.
It's conceptually, it's always good to, and properties go through cycles, conversions and changes. But some of the challenges on especially the office conversion is you're not really sure what's behind the wall on the conversion. The replacement cost and conversions is roughly around the same amount. So it's sometimes a little bit easier to start from scratch. But again, there's certain aspects, especially from reuse of materials and structures, that work to your benefit. And it's sort of positive news for Calgary. Calgary has that incentive program for the conversion of office to residential, as well as now to sort of life sciences and other type of uses. And what it does is that based on the high office availability rate, as well as some of the dysfunctional office space, allows for a new life for some of those buildings. But again, it goes back to the costs and the returns, and whether or not the cost to actually convert this, and whether or not you can get the rents going forward to justify that investment. And again, what is that perhaps exit strategy, or what is that long-term goal for that type of asset? So conceptually, I think it's a good idea, but practically, there's some concerns in regards to unanticipated costs and surprises going forward.
I know in working with our clients as well, on the valuation side of the business, we find that not every building is a good candidate. There's physical differences from building to building, locational and things like that. And on the surface, it seems like any building should be a candidate, but I think the reality is that not every building is, and that I think we're working through that still to determine how much of that space really is suitable. Maybe back to you, Peter. We did have a couple questions. I think 2 or 3 people asked about Bill 23 or similar legislation, I guess. And has this had any tangible impacts on affordability in housing? And maybe do you see it having any impact in the future?
Yeah, I mean, I think that it will have an impact. I don't know if it's all going to play out the way everybody's been sort of, thinking about it. I will just say, I'll just put my cards on the table here. I have no horse in the game. We don't do work for the provincial government or whatever on this matter. But I'm a big supporter of the bill. I mean, I think that it's the right bill and going in the right direction. I know it's got a lot of detractors, particularly amongst municipalities and interest groups and so on and so forth. But it has a number of tough measures that try to cut a lot of the headwinds there are to bringing new lands forward for housing development, and the headwinds that there have been in terms of bringing new units into intensification corridors as well that have been in place. So I think there's nothing wrong with taking a bit of a tough stand on reducing some of those headwinds to making investments in housing. Now, whether it's all going to play, have there been any tangible things yet? No, because I think that'll be years before this starts to go. These things are a bit gradual. It takes 20 years to bring a new piece of land forward for new housing, and even on intensification, it does take a number of years before you start getting investment coming from a change in policy or rules. But nonetheless, we're looking forward for many years, and I think it is the right kind of approach, and I'm sure there will be more aspects of it in the years ahead, but it is the right kind of approach in order to address many of those kind of structural barriers to getting new supply approved that the industry and home buyers have faced.
Right. And in a similar vein, we also got a couple of questions around, incentives for manufacturing in Canada, Ray, and in particular, how that might contribute to the, to the industrial market moving forward. So any comment around that? Do you see similar sort of measures being taken on that side of things, or perhaps
Well,
different?
again, it depends on the company, and the economic benefit brings a region to a particular region, and as well as whether or not it makes sense. I know that south of the border, they're perhaps a little bit more aggressive in attracting and securing based on some of that subsidies or incentives. And again, there's no details in regards to the Volkswagen plant. But again, I think it's reasonable to a certain extent to bringing that economic benefit to the region. But I think it's on a selective basis, and it can't be widespread. And we have to be very selective with offering that. But I think there's a number of positives Canada brings. What we talked about earlier, especially with respect to clean energy, and as well as perhaps a lower cost and a very, very good and strong skilled labor force. So I think there's some of those positive in addition to some of the incentives. But again, everyone is trying to target that growth in employment in North America, and sometimes it's sort of what makes sense for the region, and as well as eventually our taxpayers.
Hey Jonas, I'll just add on that last question that I answered, because I only just noticed this now in terms of the poll that the audience was asked to look at. We had asked them to comment on what was the best way governments to address affordability, and it turns out most of them, or many of them, seem to agree with me. So that's good. That almost half of our audience believes that the best way to try to restore affordability is to reduce regulations and barriers for the private sector bringing units forward, and I think that's not a surprise.
Right. It's interesting too. We also got a question in that asked if, as we, grow inventory, in particular in rental, is there any risk that this could cause an overstock of inventory in the future? Do you think? Or
well, I mean, I tried to address that directly in my comments, in the sense that I mean, I guess whenever you invest, there's an opportunity for that risk to emerge. That that's the way business cycles go. But I think that we're still fairly early on that cycle, because just because of the nature of the multifamily sector right now, in the sense that it was really dead for 15 years, and it took a long time to start getting any, like going back a ways, long time to start getting any interest and starting to build up a pipeline of new supply, and it's still just supplying 20% of the potential demand out there. So even though demand might wane, I think in many markets what we see is that the purpose-built asset, and particularly the investment grade asset that provides a variety of amenities and is and modern features and so on and so forth, is a very dominant product in the market. And so if it's competing against 30-year-old buildings, if it's competing against 25-year-old condo buildings, if it's that are owned by individual investors who don't give any, anyway, nonetheless, if it's competing against carve-outs and single-family homes and stuff, there's a lot of room for that investment grade market to continue to take larger share, even if the pie is getting slightly smaller.
Right. It was interesting. We also got a couple of questions as a follow-up to that around cap rates. And we had them, they came to us in a couple of different forms. A couple of people were asking what cap rates were for specific asset classes. Probably won't be able to answer that for you today. Somebody asked, if, how do we determine cap rates today in a world where, investment sales are limited and that. So I think that's a good one we can answer, and maybe I'll take a shot at that. So, we started to look at moving cap rates probably mid-2022. And by the end of the year, we'd moved cap rates for virtually all asset classes, by some degree, with a greater degree, obviously, in areas like office and retail, and to a lesser degree in markets like multi-residential and industrial, where the fundamentals were still pretty strong. But the truth is, there hasn't been a lot of investment activity to use as a gauge. So what we do is we spend a lot of time talking to our clients and talking to interested participants and getting a general sense of where things are moving. And that's what we've had to do in the absence of that sort of information. So that was a good question. I just thought I could answer that one myself.
Yeah, Jonas, just to add to that as well, and with our investment transaction results, it's from the initial deal to the actual close is about 3 to 4 months, right? So there's a natural lag. So, and that's where that investment trend survey is based on existing on the market, what they expect, and the deal is done. So that's a little bit more closer to what the industry is thinking about the cap rates, but definitely we saw cap rates move in the survey at least about 3 to 6 months before they actually happened when the deals actually closed. So that's a bit of a lag. But again, you just watch the interest rates and you look at availability of capital and some of the transactions, and you have a pretty good read on the direction of cap rates going forward.
Right. Well, that unfortunately brings us to the end of our time today. So thank you everybody for attending. And again, we'll try to get to some of those questions we weren't able to ask as a follow-up. As a reminder, a copy of today's recording will be sent out to all of you by email. So stay tuned to that. Thanks again, everybody.
Thank you.